Prime Minister Justin Trudeau has announced he'll assemble his cabinet in Montreal early next week to focus on the economy, and with good reason. New data out today shows inflation ticking up from 3.1% in November to 3.4% in December. Gasoline prices having a key impact on the overall consumer price index. They've been falling for the past 4 months, but are up compared to December of 2022. Food price inflation stayed sticky at 4.7%, the same rate as November, and shelter is another important factor. Rent costs alone are up 7.7% over last year. What could it mean for the Bank of Canada's first interest rate announcement of the year, happening next week? We've got two chief economists here to parse your pocketbook pressures. With me this evening, Stefane Marion, chief economist and strategist at the National Bank of Canada, and Jean-Francois Perreault, chief economist at Scotiabank. Hello to you both. Welcome to the program. Thank you for making the time.
Hi.
Hi, Stefane, I'll start with you. Was today's data from Statistics Canada on inflation in line with your expectations?
Yes, for the headline figure it was, but I have to admit that the core figure, so if you strip out food and energy, it's a bit sticky, Vassy. So that was my take on the report. I don't know what JF thinks about it.
I'm going to get JF in 1 second, but let me just follow up with you on that concept of stickiness, because I think in our day-to-day lives, we understand it, right? We're still going to the grocery store and the prices are not any lower than they were a few months ago or even a number of months ago. How problematic is the stickiness of inflation in the wider economic context?
Well, in normal times, I think the Bank of Canada should be cutting rates soon because we see weak economic activity, but if core inflation is sticky, the way it is right now, then they have to delay the rate cuts. So I think the rate cuts will come, but unfortunately, not as soon as some people might have liked. So I think it's coming near. It's coming, but not before late spring or early summer.
Do you think that's a fair assessment, JF, that although there is weak economic activity, the stickiness that we're seeing in inflation, for example, through the data today, could push out any cuts a little later than people were, crossing their fingers for about a month ago?
Oh, I think so. I mean, there's no way to look at this report and not be more worried about inflation now than we were yesterday. It was bad on multiple fronts, and in particular, Stefane indicated, these core measures of inflation, so these kind of trend measures of inflation, underlying inflationary pressures, actually are accelerating in this report. So that's really worrisome for the Bank of Canada because, of course, inflation is nowhere near 2% when you look at these underlying measures of inflation. We're talking about, 3.5 or 3.7% on a year-over-year basis and over 4.5 when you look at a monthly annualized basis. So bad numbers all around. I think it does mean for those who were hoping for a rate cut earlier in the year, that is, severely in question on the basis of this report. Now, we were always of the view that a rate cut would come somewhere around the summertime, so June. But, a report like this, if it doesn't slow anytime soon, might even put that kind of into question.
Let me ask another kind of something else, Stefane, that probably nobody wants me to put back into question, but that is about whether or not it's impossible that there might be a rate hike versus even just holding the line or a cut. Is it completely off the table that we could see another hike?
Well, you can't exclude anything, Vassy, and we know that what's happening with the shipping rates, with what's happening in the Red Sea, that, we're seeing renewed tensions, geopolitical tensions. So, but unless we see something really bad there, I still think it's going to be rate cuts. And Vassy, the reason I say this is that, yesterday the Bank of Canada also released its business outlook survey, which is pointing to a weak economy in the months ahead. And that's the recipe to get lower inflation. You got to get below trend growth or a lackluster economic growth. And I think we're in for a few months of lackluster economic growth that will send inflation lower and eventually leading to those rate cuts that JF was alluding to.
What's your sense, JF, of what things look like toward the end of 2024? I think people are sort of 2.2 million Canadians, in fact, over the next few years will renegotiate their mortgages. Even if we do anticipate rate cuts starting, let's say, in the spring, my guess is they're not going to go way down very fast.
That's reasonable. I mean, I think it's very difficult to conceive of a situation where rates aren't lower say, at this time next year or late this year relative to where they are now. I think it's a matter of when those rate cuts start and the speed at which they're cut. They're definitely not going to be cut as rapidly as they went up. There's no question about that. I mean, there were some meetings where the Bank of Canada raised by 100 basis points at a time. Our forecast is 100 basis points of cuts over the second half of the year. That I don't think is really in question, at least hopefully isn't in question, because if we do find ourselves in a situation where inflation remains problematic and the Bank of Canada can't cut as we get into the middle of the year, then I think you're looking at a very different economic outlook, one in which interest rates bite even more, where the slowdown that we expect is probably dramatically worse, where you don't get a rebound in the second part of the year. So it's a very different world by the end of this year if rates aren't lower where they are now.
It's not just a different economic world, Stefane, it'd be a different political world as well. And I wanted to ask you about something you've written that's making waves politically this week around a report you've entitled "Canada is Caught in a Population Trap," essentially arguing that the economic capacity we have is not in line with our social capacity as far as immigration policy goes. The federal cabinet is about to meet next week in Montreal. If they asked your advice about what kind of policy they should pursue to rectify that, what would you tell them?
Be aggressive, because we have this capacity constraint that cannot only be addressed by targeting students. So we have a capital stock that is declining relative to population, or the capital stock to population ratio is declining for the first time in Canadian history. And that, Vassy, when that happens, and that means that you can't be as productive as you want as a nation. That means inflation is going to be stickier, particularly with everything related to housing or shelter costs. Which we saw in the inflation numbers this morning. I was running at 6%. So that capacity constraint is impacting inflation. So again, I mean, it's a start to look at what's happening in student enrollment, international student enrollment, but it's not sufficient. I think you have to be more aggressive on temporary workers.
Stefane touched on what the government was saying, the Minister of Immigration in particular, JF, over the weekend, that they will look at a cap or reducing in the first half of this year the volume of international students, so temporary residents. Stefane's point is that the policy needs to be more aggressive to have a bigger impact. Would you agree with that?
Well, listen, I mean, it's clear that the whole immigration issue has been mismanaged for a while, right? Whether it's a federal responsibility or kind of how provinces have been able to accommodate all these folks, there's no question that there's a lot of blame to go around. I think the challenge is if you scale back on that, and I think we should, but the challenge is if you scale back on that, either you got to figure out a way to give more money to post-secondary education, so either you charge students more or you provide more tax dollars for that. Or on the flip side, if you target temporary foreign workers, in a situation where the labor market is still pretty tight, you are depriving companies of workers or potential workers, and kind of the wage consequence to that, and maybe some economic impacts of that in the short run. So it's not, there is kind of no free lunch here. There is a consequence to whatever course of action is pursued, but it's very clear that over the last couple of years, in particular, the pace at which we've increased our population is just not a pace at which our economy or our governments or our social infrastructure have been able to adapt. And it's it's not surprising. I mean, it is an astoundingly strong pace of population growth.
Yeah, the rate of population growth is 1.2 million last year, Stefane. When you talk about the government being more aggressive, can you quantify that?
I think we can't grow right now, given where we are in the economic cycle. We can't grow our population more than 400 to 500,000 a year, which would still be great, a great number by OECD standards. And Vassy, if we don't do that, we potentially incur a reputational risk, because we're not doing a good job at hosting this foreign talent that we want to bring to our country. So if we can't house them, or we can't give them the proper infrastructure, they'll leave our country. You see, that's the reputational risk that we're facing. We got to be better host to this foreign talent that we're trying to get.
Final question to you, JF. I think a lot of Canadians are viewing this through a housing lens. We're a very welcoming country to immigrants. We know that so much of our economy is built on their contributions, but in particular where housing is concerned, How much of an impact do you see the government's immigration policy as having had on the issues Canadians are facing right now as far as accessibility and affordability in the housing market?
Well, listen, there's no question there's a link, but it's a little bit of a simplistic assumption to make that, you know, the population growth the last year or so is kind of the key determinant there. The reality is we've had a housing shortage for quite a number of years. Of course, the more rapidly you grow population, the worse that challenge gets, and we're seeing that. But it's really building on a foundation of, you know, kind of a system where supply has just not been able to respond to demand for quite a long time. And of course, when you jack up demand as fast as we are now, you know, that system breaks even further. But there's no question. I mean, you look at rent growth, for instance, there is a very clear link between rent growth and population growth. So we know in real time that there is a challenge, kind of a rising affordability challenge that flows from the very strong immigration flows that we've seen, which you know, unfortunately makes life difficult for Canadians and for people that are coming into the country.
Okay, I'll leave it on that note. I appreciate both of you making the time for the analysis and insights this evening. Thank you.